for a long time now, I've been a one ETF allocation investor. For a long time, I just had VOO. And then obviously for the past few years, I've just really had VT until this year where I started trying to take some different bets to increase my risk justifiably and see what I can do in calculated risks. And I realized I've thrown a lot of percentages out in my past videos, and I realized I needed to just do the math and give the exact percentages to be, transparent. Not that I was trying to be not transparent, but sometimes you just throw out a number like, yeah, that sounds about right. And then we do the math like, oh, okay. As we dive in, as always, this is not financial advice. I'm not a financial advisor. I'm just sharing the way that I'm investing right now. So as of today, I currently have 72% VT, 19% Vanguard 2070 target date fund, which I personally mentally lump in with VT. So really VT in my head is about 91% total. 0.3% QQQM. This is the brand new brokerage position that I talked about in my second video, the 2 changes I'm making to my investment plan in 2026. So that one's just getting started, which is why it's so low. And then 8% Bitcoin. That doesn't add up exactly to 100% because of rounding, but I'm just trying to keep the number simple. And just to be clear, circling back to my second video again, these percentages are just invested dollars only. I'm not including cash because cash can be very flexible for me. I might deploy it as dry powder in a down market or use it for like a large purchase like real estate or something. So I just feel like including it could muddy the picture. But I'm sharing this now because, like I just touched on it, this ties back to my second video, and 2 out of 3 things are still true from that video. I talked about increasing my cash position, investing more into my brokerage account, and buying QQM in my brokerage account to have that money before 59.5. And like I said, 2 of those 3 things are still true. I'm still building my cash, and I'm still investing in my brokerage, but what's changing is the asset that I'm investing in. So instead of building QQQM, I'm shifting that allocation towards AVUV. The reason why I'm moving out of QQM is that when I started this YouTube channel, it sort of got me thinking more clearly about why I'm tilting certain ways. And I wanted to present a logical path for somebody that's a long-term buy and hold investor and not a constant tinkerer, even though I feel like I've been tinkering with my portfolio more than normal. When I said that I wanted to build a QQM position, I'll be honest, I picked it largely because it was just like a known high-flying tech ETF. I'm like, you know what, it's high risk, throw it in there. If AI tanks, in the next year or so, then whatever. And that's not a wrong approach. I still think QQM is really good, but I didn't have a strong principle behind why I was doing it. And that's how I like to invest, is that no matter what happens, I have a why for what I'm doing. I also have touched on this. I bought some individual stocks too after doing research on those. I still like those companies. But again, I didn't have a clean position or overarching framework for why I was tilting away from VT in the first place. So I sold those positions, put them back into VT, and started asking myself a better question. If I'm going to take more risk than the global market, what percentage, what risk do I want to be paid for? Where do I want to put that risk, and what allocation feels right for what I view myself as, where can I be that feels comfortable? So AVUV is a small cap value ETF. And why small cap value? And there's really 2 main explanations if you read a lot of academic literature, a lot of investing literature, why small cap value is expected to outperform even the S&P 500 over the long term. And there's a couple reasons. So the first one, which is risk-based. Small and cheap companies tend to be more economically sensitive, they're more cyclical, and they're more, they're just more financially fragile. There's a lot more stuff that can happen. They're smaller companies. They're not Microsoft, Amazon, who have these big conglomerates, right? And because investors, dislike holding those risks, especially in bad economic times, they demand a higher expected return. And that idea shows up clearly in classic asset pricing models where size and value explain returns beyond just the market. The other thing is kind of behavioral. So the value premium might also exist because of persistent mispricing. Investors tend to extrapolate recent growth way too far on these smaller companies. They'll overpay for the hot recent companies that are, the big names, and they can tend to ignore or over discount maybe boring businesses that don't have a lot of name recognition yet. And correcting those mispricings isn't easy. There's a lot of risks, there's a lot of constraints, capital limitations, whatever. So AVUV strategically tries to avoid loading up on junk, unprofitable, distressed companies that are cheap for a reason. And they're designed around small size, deep value exposure. They have a profitability screen or algorithm, and they have very flexible portfolio management. Compared to a lot of other small value index funds, AVUV tends to get more aggressive after value. They go really hard after value. They avoid the worst traps, and they reduce unnecessary turnover. They have a very rigid index rebalancing, and they have an algorithm essentially that they use to pick stocks. AVUV is trying to capture the small cap value premium intentionally and not just like mechanically. So the simplest way to kind of break down everything I just said was basically small cap value is expected to outperform because it's a basket of stocks investors don't really like holding because they're high risk, high volatility. And AVUV is popular because it tries to hold that basket while filtering out some of the worst names. Now, with that being said, and understanding why I'm tilting towards small cap value, it has historically paid a premium above the market just with higher volatility. Here is where I'm heading with my allocations. And these are the allocations I will be setting up once the market is open again. I'm recording this over the weekend. This is what I'm going to be setting up. And then I'm also going to be setting up my contributions to match these percentages. As I go throughout the year, obviously they're going to fluctuate the percentages of my portfolio, but I will want to be rebalancing in January. So 70% VT. This is my core global boglehead style position. It's going to be the meat and potatoes of my portfolio. I'm still a massive believer in VT, being diversified across the globe, across all asset sizes of companies, large cap, mid cap, small cap. Then the 20% AVUV, intentional small value cap tilt, and then 10% Bitcoin, which is basically an asymmetric bet. It's a capped risk against the financial system, basically. I ran a lot of portfolio simulations using different AVUV weights, 10%, 15%, 20, 25%, 30%, just trying to see where I liked the volatility and the potential increased returns. And so, as expected, small cap value increases a lot of volatility. I am comfortable with that volatility, and more importantly, I have a core principle as to why it's in my portfolio. The reason I went with the 20% was really, if you're going to factor tilt, anything below 15% is just, I don't want to say it's meaningless, but it's not going to drive enough of a difference in your portfolio. I almost did 15%. That one felt good enough. I'm like, okay, that's about the minimum I would factor tilt, but I wanted a little bit more. I really believe in the literature and all the studies done behind small cap value ETFs. And so I liked 20%. 25 and 30%, I wouldn't be sure if I could stomach it. It's a lot of fluctuation. Like there's AVUV can be very volatile. So I kind of tried to go with the Goldilocks number. My rebalancing plan, which I think I touched on, was I'm not going to be constantly tweaking this. I know I've made some changes this year, but I plan to move forward with these target percentages and rebalance once a year within these 3 different buckets per se. So no fiddling, no reacting to headlines, just sticking to the framework. This isn't about chasing what's hot. It's about having a clear reason for every risk I take and a core principle behind it. VT stays the core. AVUV is a deliberate, understood, mathematically researched tilt. Bitcoin is a capped asymmetric bet. And that's the structure that makes sense to me right now. And I just wanted to share it transparently.